All right, let's dive right into this explainer, which is basically designed to be your ultimate study survival guide. If you're an accounting student, you already know that dealing with concrete, straightforward numbers is one thing, but figuring out how to account for things that only might happen, well, that's a whole different ballgame. Today, we are going to completely demystify ASB 137, which deals with provisions, contingent liabilities, and contingent assets. By the end of this, you'll have the exact tools you need to confidently tackle financial uncertainty on your exams, and more importantly, you'll know how to dodge those sneaky traps examiners literally love to set.
Here's our roadmap for mastering this standard today. Navigating financial uncertainty, the recognition decision tree, measuring your provisions, tricky scenarios and traps, and finally, handling contingent items.
Section 1. Navigating Financial Uncertainty.
So a provision is really the hero of our story today. To completely wrap your head around it, think back to your basic conceptual framework definition of a liability, right? A present obligation to transfer an economic resource because of a past event. Your key takeaway here is that a provision is simply a subset of a liability. The defining factor, the thing that separates a provision from a standard liability, like a regular bank loan, is uncertainty. We absolutely know we owe something, but we just aren't exactly sure when we have to pay it or exactly how much it's going to cost us.
Now, you might be wondering, how does a company actually find itself on the hook for one of these? Well, there are two ways. The first is a legal obligation. This one is super straightforward. It's enforced by law, it's written into a contract, or it's mandated by legislation. But the second type is where exams get really interesting, the constructive obligation. A constructive obligation just means you made a promise that you can't back out of, purely because of your own past behavior. Say your company has a published refund policy, or maybe a well-known history of replacing faulty goods even after the warranty expires. You've created a valid expectation in the minds of your customers. The law might not strictly force you to pay, but your own business practices mean you literally have no realistic alternative.
Section 2. The Recognition Decision Tree.
Okay, we've reached the holy grail of this explainer. This is the definitive cheat sheet you absolutely must have memorized for exam day. Under paragraph 14 of ASB 137, a provision is recognized only when all three of these specific conditions are met. First, the entity has a present obligation as a result of a past event. You'll hear this called the obligating event. Second, it's probable that an outflow of resources is going to be required to settle it. And third, you can make a reliable estimate of the amount. So when you're staring at a scenario on an exam, you have to immediately run it through these three mandatory hurdles. It is completely an all-or-nothing test. If it passes all three, boom, it makes it onto the balance sheet.
But what happens when a scenario fails that three-part test? Well, if you answer yes to a present obligation, but no to a probable outflow, or you just can't come up with a reliable estimate, you are instantly downgraded. You no longer get to recognize the provision on the face of the financial statements. Instead, you have to disclose it in the notes as a contingent liability. The only exception is if the possibility of an outflow is completely remote, in which case you do nothing at all.
Let's put this framework to the test with a really classic exam prompt. Imagine a legal claim has been filed against your company for an injury. Your legal counsel advises that an outflow of resources to settle this claim is probable, and they've reliably estimated the amount at $150,000. Take a second and run this through our three-step framework. Do we recognize?
The answer is an emphatic yes. It perfectly satisfies our rule of three. There's a present legal obligation from a past event, which is the injury itself. The outflow is probable, according to our counsel, and the amount is reliably estimated at $150,000. So we confidently recognize this provision on the face of the statement of financial position. See? Easy marks if you just stick to the framework.
Section 3. Measuring your provisions.
Once you know you have to recognize a provision, the next logical question is, how on earth do we value it? The standard mandates that we measure a provision at the best estimate of the expenditure required to settle the obligation at the end of the reporting period. That requires some serious professional judgment, weighing up all possible outcomes by their probabilities. You also have to factor in risks and anticipated future events, like, say, a highly reliable technological change that might reduce environmental cleanup costs. Another crucial factor here is the time value of money. If the settlement is way off in the future, you have to discount it to present value if the effect is material. And here is a massive tip for test day. As time passes, the carrying amount naturally increases. That unwinding over time hits your income statement as a borrowing cost, a finance expense, not an operating expense. You definitely want to get that right.
Okay, I want to give you a massive red flag warning right here. Examiners absolutely love to trick you with this exact scenario.
They'll give you a problem where you have to set up a provision to, let's say, shut down a factory. But then they'll casually mention that you expect to make a gain from selling off the old factory equipment. They are baiting you to see if you'll net the gain against the provision cost. Do not fall for it. Expected disposal gains must never be netted against a provision. You have to measure the expected cash outflows for the provision entirely on their own, and you deal with any inflows completely separately.
Section 4. Tricky Scenarios and Traps.
So, imagine you're reading a detailed case study about a specific company division. The economy has just tanked, and the forecast shows this division is practically guaranteed to lose a ton of money over the next financial year. The exam question asks you to book a provision for these expected future operating losses. Can you do it?
Nope. The standard strictly forbids recognizing provisions for future operating losses. Why? Because there's no present obligation from a past event. Technically speaking, management could avoid those future losses by restructuring or just selling off the loss-making operation altogether. But contrast that with an onerous contract. An onerous contract is one where the unavoidable costs of meeting your obligations are higher than the economic benefits you expect to get back. In that case, the contract literally traps you in unavoidable costs, because you can't just walk away. You absolutely must account for the unavoidable net loss as a provision.
Another major trap area is restructuring. This is honestly one of the most controversial areas in accounting because of big bath abuses, where companies try to aggressively flush all their future expenses into a massive restructuring provision today just to make future years look artificially profitable. Because of that, IASB 37 demands strict proof of a constructive obligation. You need a detailed formal plan, and you must have raised a valid expectation in those affected, usually by making a public announcement. Furthermore, you can only provision for costs that are directly and necessarily caused by the restructuring. Things like future marketing, investing in new IT systems, or retraining continuing staff are strictly excluded because they relate to the entity's ongoing activities.
And finally, Section 5, Handling Contingent Items. Let's talk about the fringes, contingent assets. A contingent asset is a possible asset arising from a past event, but its existence will only be confirmed by uncertain future events that are totally outside the entity's control. Think of a lawsuit where your company is suing someone else and you might win a huge settlement. Remember, accounting is inherently conservative. That means contingent assets are treated with extreme caution. They are never recognized on the financial statements. They are only disclosed in the notes, and even then, only if the inflow of economic benefits is probable. It's a much stricter, much more conservative mirror image threshold than the one we use for liabilities.
Now, this comparison right here acts as a fantastic exam cheat code. It contrasts the strict general rules of ASB 137 against a very specific, highly testable exception. Generally, under ASB 137, a contingent liability requires a probable outflow to be recognized as a provision. If it's not probable, it's just disclosed. However, if you acquire a contingent liability during a business combination, like you are buying another company, ASB 3 takes over. Under ASB 3, the outflow actually does not need to be probable for it to be recognized. As long as it's a present obligation and its fair value can be measured reliably, it goes straight on the balance sheet. Examiners love to test if you know exactly when to switch between these two standards.
As you leave this explainer and head into your exams or eventually out into your professional accounting career, I want you to keep one big thing in mind. Many top financial analysts regard the contingent liabilities note as one of the absolutely most critical parts of an annual report. The balance sheet only tells you what the company was certain enough to recognize, but the true story of a company's hidden risk exposures, their pending lawsuits, and their potential future disasters, that's often buried right there in those uncertain footnotes, just waiting for a sharp eye to decode them. So when you look at the next company you analyze, ask yourself, what hidden risks are lurking in the fine print? Keep studying hard, trust the decision tree, and I'll catch you next time.